You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today I want to talk to you about listed investment companies. Now, listed investment companies are basically an actively managed fund. Okay. Now, they operate similar to an ETF, but there are also some vast differences. So I'm going to talk to you basically about how they work. Now, a listed investment company is basically a structure which gets listed on a stock exchange, and you can purchase shares within this company. What listed investment companies do is when they IPO or do an initial public offering, they set an amount of shares they wish to list in their share market with, and then they go live with that amount. Okay. So they are a closed-ended fund, meaning they don't just issue new shares as the funds under management grow, much like how an ETF does. When you are holding a listed investment company, if you set up dividend reinvestment plans, when the LIC or listed investment company issues new shares to you, they are actually new shares. They are not pre-existing ones that are bought and sold by the company. They just issue new shares within the company. So despite it being closed-ended, they do issue new ones under the dividend reinvestment plan. And this is often offered at a discount also. Now, with a listed investment company, okay, they often will have a manager which basically looks after the investment objective of this particular company we're talking about. So if it is to loosely track sort of the top 200 companies in the ASX on the Australian Stock Exchange, so they will basically buy and sell and do all of the management of that as required. So it operates different to an index fund, which is passively managed. It is not requiring any rebalancing every day. It's done quarterly. So a listed investment company can choose to do this frequently. Now, because they are a company structure, this means the share price can trade at a discount or a premium to the net tangible assets for each share, okay, or the tangible asset value. So when buying a listed investment company, you can simply search for the ticker symbol in Google, okay? And when you do that, you'll say NTA. So you might, for example, use Australian Foundation Investment Company. So you write AFI NTA, and this will come up with their net tangible assets of what is held within each share, essentially. So if we look at today's price for AFI, this is about $7.49, okay? If you search the NTA for AFI, however, this is around about $7.08. So currently, AFI is trading at a large premium. Now, this is because based on market demand, the price can fluctuate uncorrelated to what the value of each share is, much like how a normal company in the share market works. An ETF, however, because there is just new shares issued as more funds come under management, and this stays very much in line with what the investment objective of the ETF is doing, and it automatically rebalances based on the companies within that holding growing and coming down. It's very much in line with the actual assets of the ETF. So because of that, a listed investment company can be very efficient to buy, because it's like it's on a slight sale when you can get it at a discount, or it's like you're overpaying when you're purchasing at a premium, which means you can buy low and sell high a lot easier using listed investment companies. Now, when you invest in a listed investment company, because they are a company receiving dividends and trading the shares as they do for their investment objective, okay, they can pay their corporate rate of tax at 30% on any of the distributions or capital gains that they earn. When they then pay a distribution to you, the shareholder, this will come with what's called a franking credit here in Australia. Now, this franking credit gives you a credit of 30% based on the tax rate you would have already had paid by the company that you were purchasing, meaning that you may actually get a slight refund or a credit on your tax obligation when you complete your tax return later on. Now, the franking component of your dividend doesn't count towards your dividend reinvestment plan. Only the actual distribution itself does, but the franking credits very much boost your cash flow, especially if your tax rate is lower than that 30% that the company has already paid on your behalf. I plan to do a franking credit video in the future where we go into this in a lot more detail and we can explain how everything works, okay? So that'll be really good. Now, when buying a listed investment company, what's really cool about this is when you own shares in a company, this company has no obligation to pay out their shareholders a dividend, let alone 100% of their cash. Whereas an ETF has to pay out everything they earn in distributions to the shareholders every quarter or every 6 months, or whichever time period it is that ETF has agreed to pay out dividends. Now, with a listed investment company, this means that they can hold on to some cash, allowing them to sort of, time the market a little more. They can purchase shares when they're trading at a discount, meaning the assets under your shares can actually grow a lot faster if the manager in that fund is able to find good opportunities in which they can deploy that cash. When you hold an ETF, this is not possible. You simply receive dividends, the fund size grows as they keep buying correct to the weightings and the investment objective, and any cash they earn has to become handed back down to the shareholders through a distribution. Now, by the listed investment companies holding so much cash, this gives them an opportunity to still pay a consistent dividend amount during times of market volatility and downturn. So this is where listed investment companies can create a lot of confidence, a lot of stability in that income, and give you some sort of security if you have some of these in your portfolio, because you're going to have a consistent dividend income through those times where your ETFs may not be able to distribute as much cash to you. So here in Australia, we have a few very, very old school listed investment companies which have grown their dividend over time. They've outperformed or slightly underperformed the index, so they track it very closely depending on their objective. Some differ slightly in their investment objective, however, it's very much an overlap of the companies that are being held. And a lot of them have a very long-term track record. So I'm going to talk to you about 3 listed investment companies in which we're going to go through just a little bit about their management expense ratio, how they're able to keep it so low, a little bit about their funds under management, and also why I find these to be a really good investment opportunity. So I'm going to talk to you about first Australian Foundation Investment Company, or AFI. Now, AFI has an extremely low management expense ratio, or MER, of just 13 basis points, or 0.13%. Now, this means for every $10,000 you have invested, your fees are only $13 every single year, which is huge, 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 because we're paying very, very low fees in order to have our funds managed and receive a really good return. Now, AFI charges 0 performance fees, unlike a lot of hedge funds and actively managed funds, which give you a fee if they outperform the index. So AFI does not charge this, and they currently have $7.2 billion in assets. So that's pretty amazing. Now, AFI has been one of those sort of Australian darlings in the listed investment company space. Everybody has received very good dividends by being invested in this. And the dividend yield, when you account for franking credits plus your distribution, is generally at around 6%. So you can be very confident in getting a good return with this. Now, AFI also offers, on top of their dividend redistribution plan, dividend reinvestment plan, they also offer a bonus share plan, which means instead of receiving dividends in return for a taxable dividend, you can actually just have shares allotted to you and you don't have any tax associated with it because you defer the dividend. However, the way this works can be very tricky when it comes to lodging a tax return later down the track. This makes sense though if you're trying to keep your income a bit lower, because it does not add to your taxable assessable income. Now we're going to look at another listed investment company here in Australia, Milton Corporation, or ticker symbol MLT. Now this has a very low management expense ratio, although slightly higher than AFI, of 15 basis points, or for every $10,000 you have invested, a fee of $15. Again, Milton charges a 0% performance fee and has $3.32 billion under management. Now, Milton Corporation also sometimes pays a special dividend, which is fantastic. So in between your normal biannually dividends, they have been known to pay out a special dividend, which very much benefits shareholders. Again, they have a very long track record of increasing dividends, and shareholders have once again earned a very good return by being invested with Milton. The last listed investment company I want to talk to you about is AUI. Now, this is the Australian United Investment Company. Now, AUI has a very long track record of increasing dividends ever since their inception back in the 1950s. They have just a 10 basis point MER, or 0.1%, meaning for every $10,000 you have invested, it's only a $10 fee per annum. They charge zero performance fee, and they have a large portion of their portfolio held in financials and banks. This means when the banks are doing really well and paying amazing dividends, AUI performs really well. When it's not, it does suffer a little bit, and in recent years it has underperformed the ASX 200. However, this is still a brilliant fund to have in your portfolio, in my opinion, and I do hold this because it constantly increases its dividend. It is very stable, and it has a very low management expense ratio, meaning that it is very good in order to invest in this company and not pay an exorbitant amount of fees. So I personally hold AFI and AUI. I do not hold Milton. However, Milton is another really good investment vehicle. Now guys, I hope when you look and research into what shares you're looking to buy, you can find diversified trades through an ETF or an investment company, a listed investment company. And I hope this gives you a little bit of insight as to why an LIC may be actually a really good option for you. Having the stable dividend income can be very promising. Getting the franking credits can help a lot with your tax obligation, and they generally perform very well, especially those granddaddy sort of listed investment companies with a track record of increasing dividends over 50 years. They are the ones we definitely want to be keeping our eyes on. If you happen to find these at a discount to their NTA, as I mentioned before, and then later on down the track, if you wish to sell while it's at a premium, that's amazing because you're able to lock in some of that gain. You've got that share on sale. So it is actually easier to find a very good bargain when buying listed investment companies than it is compared to ETFs. However, ETFs have to pay out all of the cash they earn, as opposed to your LIC, which can hold cash in order to ride out those volatile times. Guys, I hope by talking about listed investment companies today, you've learned something, and perhaps it's something you can start researching and look at adding to your portfolio if you like what you find out. Leave a comment below if there's any questions you have, and I'll do my best to answer it. And if you got any value from this video, please like, share, and subscribe. And we can talk about listed investment companies later down the track as well, where I plan to possibly go through individual ones in a lot more detail. All right, thanks for watching, and I look forward to seeing you in the next video.